You think eventually this is a great stock?
Well, I think eventually it's going to become profitable. It's got a few things in its favor. I think the platform that it has can actually create, what we refer to as economies of scale. I think the demand for ride sharing continues to increase, and that's going to, of course, attract drivers onto that platform. So it's got the network effect, moat source or competitive advantage that we think that's sustainable. So, in about 3 years, we actually see these guys becoming profitable and expanding operating margins going forward.
Oh, you're a lousy bear. Anyway, Tom, are you more bullish than Ali?
I'm bullish to a point. It's funny. I mean, I have a buy rating on the stock and the $75 target. I don't have them EBITDA profitable until probably 2023 or later.
And that's EBITDA. It's not even profit.
Yeah, that's EBITDA. Free cash flow trends are actually better. They have some sort of working capital benefits in their business, so they'll show better free cash flow trends than they do.
Everybody's, just listening to both you guys, nobody knows what the hell to think of this company because it can't be valued.
Well,
on
I
any
think
normal.
there is a significant kind of blind spot on operating expenses, and particularly the incentives that Lyft uses to attract riders and drivers. On top line, I think there's pretty good visibility, and that's what we think is going to.
So here's the question I have about how investors are going to look at when we finally see the first quarter earnings that are public. In terms of incentives, promotions, marketing, all of that, does that number have to,
quarter results?
First quarter results. Does that number have to come down materially, or do you want them spending so the revenue number's higher?
I'm not sure that number is going to matter here over the next couple of quarters. I think that the management team out on the roadshow was very clear that 2019 is a peak investment year. From the investors we talked to, it seems like, at least here for the next couple of quarters, we think top line is going to, bookings and top line
matters more.
Top line's going to matter more. Now, of course, profits matter, but I think here over in the near term.
Why do you think this is an investing high water mark? I mean, if what matters is top line, what makes you think that spending is going to slow?
Well, to echo a little bit of what the former speaker said, at its core, this is a two-sided marketplace business. It has very low capital intensity. There are real networks effects when you get these two-sided marketplaces to a certain scale. They attract riders. The more riders attract more drivers, and so on. These businesses tend to be significantly profitable as long as they can be the number one or number two player in a market. And I think that's the real challenge for Lyft is the North American market big enough where a number two player can kind of really drive those economies of scale and network effects?
I think we're missing some real obvious value here. I think there can be a lift for Lyft. And what I mean by that is I read some of the notes on this. In order to justify the current market valuation, investors need to take a big leap of faith that the millennials and later generations will forego ownership of a car and opt instead on reliance of ride sharing. But millennials are also purpose-driven, and they're mission-driven, and they're looking for companies that have a purpose and a mission. And we're in a gig economy right now. These companies these Lyft and Uber have contract drivers. Nothing wrong with it. But these folks don't have health insurance and benefits. They're basically small business owners, Joe. And so let's lean into them. I think that we can, Lyft has a chance here, and Uber after them, to sort of upgrade capitalism itself. Let's do financial well-being. Hope Financial, a community private banker, doesn't have to be Operation Hope, any nonprofit, for the drivers. Help them with their financial well-being. Lean into them so they're, by the way, less angry when somebody gets in the car to get her drive, because that's your ambassador. That Lyft driver or Uber driver is your ambassador for your market share. I think that the profitability will go up. People will lean into the investment more because it's a company with a purpose. It takes the noise out of the balance sheet because now you know that your most important asset, that driver, is not going to abandon you or steal from you.
Unfortunately, there's a target on the driver's back in the future for autonomous vehicles. They're trying to get rid of the driver as their, as the driver
as a big cost.
Is the most important part of it.
It becomes your value proposition because now I trust the drivers, right? And I think that, again, by reinvesting into the drivers, if you can't pay them more, treat them better. Financial coaching is cheap, but it's a credible investment. This is financial literacy once again. We have to lean into the American worker who's got too much month at the end of their money.
They did put out an announcement on Friday when they went public that they were making, every year they'll be paying either $50 million or 1% of profits, whatever is larger, for something else outside the company. Maybe that money would be better spent investing in the drivers.
That's fantastic, by the way. I'm not talking about philanthropy. I'm not talking about we are the world, we are the... I'm talking about the business plan of Lyft, Uber, and
Right.
every other gig economy company who's relying on contract workers who have got too much month at the end of their money by showing America we understand you're struggling.
Right. Let me ask a different question of both of these guys because it relates to the costs.
And I think it'll
involved in
help
doing
your
these
bottom
things.
line.
So Lyft has recently, not invested in what you're talking about, but all of these companies are now trying to figure out what can they do for the drivers. Lyft is setting up these driver centers where you can actually get the car, bring the car in if you have a problem, get them fixed up much more quickly.
Yeah.
There's lots of things going on. So how much of the investment do you want to see in things like this? Or if you saw them investing in financial literacy, which I think is fantastic from a sort of, theoretical idea, but economically, will investors applaud that or not?
Look, I think Lyft it's going to be tricky for them to find that balance between reducing their reliance on these incentives and bonuses for drivers, which they need to do to help drive profitability. The company's talking about driving leverage in things like insurance costs and payment processing,
right.
but I think total incentives last year were over $800 million for drivers and riders. So that's clearly a very big lever for them being able to achieve profitability. But there is PR risk from them doing that. There's also risk to the business from drivers peeling away. And I think what's important for Lyft is one of the big reasons why it's been able to gain share over the last couple of years versus Uber is them leaning into their brand as differentiated around corporate responsibility and socially conscious
Ali,
values.
do you
and that's going to be a tough thing for them to balance.
any final thoughts, Ali, on I mean, not you look fine, but any just to wrap this up, we got to go. But you've been listening patiently?
Yeah. No, thanks. But yeah, I mean, I think the main thing is this requires some patience. I do say, as you mentioned, it's a neutral, and we do think that in the long run they will reach that economies of scale and progress towards profitability, probably 3 to 4 years from now.
All right, and I don't know what it means for Uber, but that'll make the Lyft IPO look like. I mean, the coverage we're going to give Uber is get ready, Sorkin. You're going to be on the road somewhere. I don't know.